All right, welcome back. A lot of people hear the word options and they immediately think of lottery tickets, risky, speculative bets on where a stock is headed. But honestly, that's only half the story, and it's by far the least interesting half. Today, we are going to pull back the curtain and look at how the pros use options not as a gamble, but as a high-precision toolkit. We're going to explore how you can use these exact same tools to generate income, to protect your hard-earned portfolio, and really to navigate the markets with a level of control you probably didn't think was possible. We're going way beyond just buying calls and puts today. We're stepping into the world of real strategic portfolio management.
So, let me just start with a question for you. What if you could set up a system that generates a consistent, almost predictable income stream from the stocks you already own? I mean, imagine getting paid every single week or month just for holding your long-term investments. Or how about this? What if you could put a protective shield around your entire portfolio, making it practically immune to a market crash? And what if you could do it for free? Now, I know it sounds like some kind of financial magic trick, but it's not. These are the exact outcomes that advanced option strategies are built for, and today we're going to break down precisely how they work step by step.
To really get a handle on these strategies, you've got to grasp one single powerful idea first. I want you to think of the options market as this huge global insurance marketplace. That's all it is. And in this market, you get to choose which role you want to play. On one side, you can be the insurance seller. You're like the big insurance company. Your whole goal is to collect regular, consistent payments. We call them premiums. You're just hoping nothing bad happens so you can keep collecting that income as time ticks by. Then there's the other side. You can be the insurance buyer. You pay a small premium to protect your valuable assets, your portfolio, from some catastrophic event, like a house fire or a market crash. Your goal isn't really to profit, it's just to sleep well at night knowing you are protected. Every single strategy we talk about today, it's going to fall into one of these two camps. Are you the insurer or are you the insured? That mindset is the key to everything.
So, here's our game plan for today. First up, we're going to step into the engine room, get a feel for the forces that really drive options pricing. Then, we'll open up the income generation playbook and learn how to act like that insurance company. After that, we're going to flip the script completely and build the portfolio protection shield. And finally, and this is so important, we'll cover the non-negotiable rules for managing your risk like a pro.
All right, let's get into it. First section, the options engine room. Look, before we can even think about building these strategies, we have to understand the fundamental forces that make them tick. These are known as the Greeks, and they're basically the control dials on every single trade you're ever going to make.
Let's start with the one that's probably the easiest to understand, delta. Just think of delta as the speedometer for your options price. All it does is tell you how much your options value is expected to change for every $1 move in the stock. So for example, a call option with a delta of 0.50, it's going to gain about 50 cents in value if the stock goes up by $1. A put option with a delta of negative 0.50, well, it's going to gain 50 cents if the stock goes down $1. See? Delta is simply a measure of your directional bet. You think a stock's going up, you want positive delta. You think it's going down, you want negative delta. It's really that straightforward.
Okay, now for what is arguably the most important Greek for our entire conversation today, theta. Theta measures the relentless, unstoppable power of time decay. You have to remember, every single option is a decaying asset. It has an expiration date, and it's just like a melting ice cube. It loses a tiny bit of its value every single day, as long as the stock price stays put. And this decay, it isn't a straight line. It speeds up like crazy in the last 30 to 45 days. Now, if you're an option buyer, this is a constant uphill battle. But if you're an option seller, our insurer, then theta is your absolute best friend. It is the ticking clock that works in your favor day after day, transferring value from the buyer over to you. When you sell an option, you are literally selling time, and theta is your paycheck.
And finally, we've got Vega. Vega measures how sensitive an option is to changes in something called implied volatility, which that's just a fancy way of saying the market's fear gauge. When uncertainty is high and traders are expecting a huge move, volatility spikes. And guess what? All option prices get more expensive. When things are calm and boring, volatility drops and options get cheaper. This is absolutely crucial to understand. As an insurance seller, you want to sell your policies when fear is high, when prices are inflated. Then you just sit back and hope that volatility decreases after you've made your trade. We call that a volatility crush, and it's another way you make money. But if you're the insurance buyer, the portfolio protector, you want the exact opposite. You buy your protection when it's cheap, and it's that sudden spike in fear that makes your insurance policy pay off. Big time.
All right, let's move on and see how this all comes together. Welcome to the Income Generation Playbook. For this section, we are putting on our insurance seller hat. Our whole goal here is to sell policies to other people in the market, collect that premium, and aim for high probability, consistent wins.
Let's kick things off with a really brilliant strategy called the wheel. This is perfect for those high-quality stocks that you wouldn't mind owning for the long haul anyway. So here's how it works. Step 1. You sell a cash-secured put. Basically, you get paid a premium today. In exchange, you're just promising to buy 100 shares of a stock at a price you choose, but only if the stock drops to that price. Let's say a stock's at $100, but you'd be thrilled to buy it at $95. You go ahead and sell the $95 put, and you collect cash on the spot. If the stock stays above $95, the option just expires worthless, and you keep the premium, free and clear. Okay, step 2. What if you get assigned? Well, if the stock does drop below $95, you simply fulfill your promise and you buy the 100 shares at $95 each. But here's the thing. Remember that premium you collected? Your real cost is actually even lower. You just bought a great stock at a discount. And finally, step 3. You sell a covered call. Now that you own the shares, you turn right around and sell someone else the right to buy those shares from you at a higher price, maybe $105. And for selling them that right, you collect a second premium. The wheel just keeps on turning.
So as you can see, the wheel is just this powerful engine for generating income. You make money from selling the puts. If you end up buying the stock, you immediately start making more money by selling calls against it. And if your shares get sold for a profit, you're back to cash, ready to start the whole cycle over again. It's this methodical process designed to do one of two things: either generate cash flow or let you buy stocks you already like at a price you want to pay. You pretty much win either way.
Okay, that's great, but what if you have no idea which way a stock is going? What if you just think it's gonna, well, do nothing, go sideways? For that, there's the Iron Condor. Just like the quote says, it's a defined risk, non-directional strategy. You're not betting up or down, you're betting on sideways. You're basically selling insurance to both the bulls and the bears at the exact same time.
Now, I know, at first glance, this four-legged thing looks complicated, but I promise it's just two really simple strategies bolted together. Each half is called a credit spread. All that is selling one option and then buying another one further out to define your risk. You get a net credit up front. So for the Iron Condor, first, you sell a put credit spread below the stock's price. So here, we sell the $95 put and we buy the $92 put for protection. That's our bet that the stock will stay above $95. Then, at the same time, we sell a call credit spread above the stock's price, selling the 105 call and buying the 108 call. That's our bet the stock will stay below 105. By mushing them together, we get paid to bet that the stock will just stay stuck inside that $10 range.
And here's the beautiful part. Let's put some real numbers to this. To place this trade, you'd collect a net credit, let's say $120. That is your maximum possible profit. As long as that stock price finishes anywhere between 95 and 105 at expiration, you keep the full 120. And your risk? It's perfectly defined from the get-go. The distance between the puts is $3 and the distance between the calls is $3. That means your maximum possible loss is $300. But since you already collected 120 up front, your actual risk is only $180. So you're risking 180 to make 120. The key takeaway here is you know your exact profit potential and your exact max risk before you ever even click the button. No surprises.
All right, so we've learned how to be the insurer. Now, let's flip the coin. Let's explore the portfolio protection shield. In this section, we're taking off the seller hat and we're putting on our insurance buyer hat. The goal here is not to generate income. It's to use options defensively to protect the investments that we've worked so hard to build.
So let's check out this really elegant strategy called the protective collar. Imagine you own 100 shares of a stock, it's had a fantastic run, and now you're getting a little nervous. You want to protect those gains. Okay, step 1, you buy the floor. You go out and you purchase a protective put option below the current price, let's say the $95 put. This is your insurance policy. It gives you the absolute right to sell your shares for $95 no matter how far the stock might fall. But insurance costs money, right? So step 2, you sell the ceiling to pay for it. To fund that put you just bought, you sell a covered call option against your shares at a price above the current market, say $105. The premium you collect from selling that call can offset or maybe even completely cover the cost of the put you bought. When the costs match up perfectly, we call that a costless collar. You've basically just created downside protection for free.
Now, it is absolutely essential that you understand the trade-off here. A protective collar is not a free lunch. You are making a conscious choice to trade away your unlimited upside potential in exchange for guaranteed, rock-solid downside protection. So,
If the stock just unexpectedly rips to $150, yeah, you're going to miss out on some of those gains because your shares will be sold at your ceiling price of $105. But if the market tanks and the stock plummets to $50, you've locked in your exit at $95, saving yourself from a catastrophic loss. It's not about trying to predict the future. It's a strategic move to protect the profits you already have.
Okay, so protecting one stock is great. But what about a diversified portfolio with like 20 or 30 stocks in it? I mean, buying individual insurance policies on every single one of those would be incredibly expensive and just a mess to manage. So how do you protect an entire portfolio?
Well, the solution is to use index options. Instead of buying insurance on every single house in your portfolio, you just buy one single policy on the entire neighborhood. And you do this by buying puts on a broad market ETF, like the SPY, which tracks the S&P 500. Because most stocks tend to move with the overall market, this works as a really effective hedge. So let's just run the numbers real quick. If you have a $500,000 portfolio, and the SPY is trading at, say, $450 a share, each options contract controls a value of $45,000. A quick calculation shows that to insure your entire $500,000 portfolio, you'd only need to buy about 11 SPY put contracts. It is an incredibly efficient way to hedge against that big, scary market-wide risk.
And now for our final and what is arguably the most important section, managing risk like a pro. I mean it. Knowing all these fancy strategies is useless. In fact, it's downright dangerous if you don't have a disciplined framework for managing your risk. These are the non-negotiable rules for survival and long-term success in this game. Let's start with the single most important rule in all of trading: position sizing. You should never ever risk more than 1 to 2% of your total trading capital on any single idea. For a trade with defined risk like our Iron Condor, this is super easy to calculate. If your max loss is $180 and you have a $10,000 account, you're risking 1.8%. Perfect. This rule isn't just about math, it's about psychology. It makes sure that no single bad trade can ever knock you out of the game, which lets you trade with a clear head and stay in it long enough for your strategies to actually work over the long run. Next up, you have to have an exit plan before you even enter a trade. First, take your profits early. For income trades, a really common rule for pros is to close the position once you've captured 50% of the maximum profit. Now, why would you do that? Because you capture most of the profit in a fraction of the time, which dramatically cuts down your risk and frees up your capital for the next opportunity. Second, cut your losses decisively. Hope is not a strategy. Have a predefined point where you just admit, hey, this trade isn't working, and you get out. And finally, avoid gamma risk. This is a huge one for sellers. In that final week or two before expiration, an option's price movements can become just wildly unpredictable. A small move in the stock can cause a massive swing in your P&L. There is just no reason to take that kind of risk. Most pros close their positions with at least a week and often even 21 days left on the clock.
So, to kind of wrap it all up, here is a practical, pre-flight checklist to run through before you place any income trade. Is the option liquid? Meaning, can you get in and out easily? Is the implied volatility rank high? This is so key. It tells you if insurance prices are expensive right now, which is exactly when you want to be a seller. Is there a big event like an earnings report coming up that could just blow up the trade? And finally, the basics. Do you know your max loss, your profit target, and what your exit plan is if things go south? Just taking 30 seconds to run through this list will save you from so many preventable mistakes.
We have covered a ton of ground today, from the engine room of the Greeks to income strategies like the wheel and the Iron Condor, and all the way to protective shields like the collar. Now look, these are sophisticated tools, and they do require practice and they require discipline. But you now understand the core framework. So, the final question is really for you to think about for your own portfolio. When you look out at the market, are you going to be the insurer, collecting premiums for taking smart, calculated risks, or will you be the insured, paying for the peace of mind that comes with real protection? The choice is yours.